Good evening and welcome to this retirement planning webinar with Kelly Capital Partners. Here now are Kelly Capital's Janie Kelly and WMUZ's Bob Duco.
Well, welcome everybody. Happy to have you with us today. And I'm really looking forward to this webinar. I am. We appreciate all of you folks joining us, being part of this. And I'm really happy to listen tonight to my friend Janie Kelly, who retirement income certified professional managing partner of Kelly Capital Partners, and of course, longtime advertising partner for my show and a friend for several years. Hey, Janie, how are you?
Hey, Bob. I'm doing well. Happy to be here with you.
Well, you too. Always good catching up with you. You know, usually, usually we have like the last Friday of every month, we have our catch up on what's happening with finances and retirement and the market and everything else. And if you remember, I told you the other day when you and I were talking, this entire webinar talk about apologetics and politics, and I'll talk about retirement, investments, and finances. What do you think?
And that's when I said, I don't know enough about the news, Bob. I can't keep up.
I know. Oh, I would be totally lost. I mean, tell me about it. So, well, I'll tell you what, I know we're really going to learn a lot through the course of this seminar, and I appreciate everybody being here with us. And I'm looking forward to learning a lot too, Janie. So with that said, I'm just going to turn it over to you.
All right, great. Yeah, thanks everybody for being here. I really wanted to start with a story. I had a woman come up to me one evening after I was speaking at an event. She was a nurse. And she was working that shift, from 7 o'clock in the morning to 7 o'clock at night. She was about 68 years old and had some health issues also. And she said to me, you know what, I just don't think I can do this any longer. I just don't know how much I can keep this up. And so I had her in right away and she brought me all of her information. And I took a look at her budget, was all laid out. She had everything perfectly aligned and she knew that she did not want to take that mortgage with her into retirement. And so she had that paid off. She was doing a great job contributing to that 403B, which is like a 401k if you're not familiar, for a nonprofit. And so she was also utilizing that catch-up provision, after age 50 where you can go ahead and add more. So she really did have a sizable 403B. She thought she was going to have to work, though, till she was like 72 or 73. But when we laid everything out, she was actually able to go ahead and retire. She went in the next day and she gave her notice that she was going to be retiring. And for her, which, Bob, it's like so many other people, they just have this amount of money in their head. It's like a number, that they've saved up this money all their life. But how do I take this money now and pay this back to myself for the rest of my life without running out of money? So how much is too much to take where I maybe live to 95 and I run out of money? But also, you've worked really hard for this money. You want to be able to enjoy it. You want to be able to enjoy your retirement. So what's a good amount to spend? And I think that is where people really get conflicted, and that's where it gets hard to try to determine that. And that's where retirement planning comes in and why it's really important at retirement that you have a total plan. And we always say this because a lot of people think, I've got investments, but that's really just not a retirement plan. That's not enough. That's great when you're in that accumulation phase. You got those investments growing and accumulating for yourself. That's great. But now it's a different deal. And so I'm going to go ahead and share my screen. Hopefully this will work. All right, so far so good.
All right.
All right, so this is really the 5 key areas of retirement planning. We want to make sure that we've got a plan for investments, income, legacy, healthcare, and tax planning. With income planning, we now need that at retirement because we're not going to be working anymore. We don't have wages coming in. And so what does that mean? It means we want to look at our Social Security and maximize that. Figure out when is the best time to take that Social Security, especially if you have a spousal benefit or a survivor benefit option for you. It gets a little bit more complicated. We want to make sure that we're planning for inflation, of course. In retirement, inflation is something so important. We need to really pace it and pay attention to it because it's one of those things that just kind of creeps up on you and you don't always pay attention to it. But we know that at an average rate of inflation of 3% a year, that the cost of living doubles in 24 years. And when you think about 24 years, I mean, that's not that long to be in retirement anymore for, because we are just all living so much longer. So in retirement, your sources of income have to increase every single year. And then also want to plan for the spousal plan, making sure that the money is there for whoever predeceases their spouse. What's the plan in place? Because we know that the smallest of the Social Security is eliminated. So we want to make sure we're set up correctly there. But also investment planning, very, very important. It's just not the whole thing. But we want to make sure we have your risk tolerance in check. We use a software in our office called Riskalyze, and basically it gives you a personal risk score with this software. And a lot of people, when they take this assessment, we find that they're taking on more risk than what they're comfortable with. And that's such an important part of it, because you don't want to have a knee-jerk reaction when the market stresses and then jump in and sell everything because you're afraid that you don't know where the bottom is. So we really take getting risk under control. We really take that super seriously. But also tax planning. You know, taxes are number 2 after healthcare for expenses in retirement. And we just want to make sure that we are assessing the taxable nature of your assets. Do you have a lot of qualified money? Meaning, have you been deferring money all these years like most people have in a 401k plan or in some sort of a employer-sponsored plan? Well, that's money that's going to be taxed when you take it out. So we want to make sure, did we set up some Roth assets? Can we help you do that now? And what are some of the rules around those Roth assets? Because that would be tax-free money when you withdraw that money for sure. But then we also want to look at healthcare planning. With healthcare planning, do you have a plan for long-term care? And not everybody does, but there are some options that are out there that are a little bit less expensive. And we didn't allow for anything to go on to the beneficiary if you never had a long-term care event. But those plans, we're seeing those get a lot more flexible, and they're getting smarter because they're seeing the need here with the longevity and the fact that many people are going to need some assistance with long-term care. But then the last one is really legacy planning. And I have to say it's so important that we get the will and the trust set up. And really, I would say about 40% of people that come in don't have that done. And we really want to make sure that you get your end-of-life decisions made, that you get a power of attorney, that your assets are protected in case something happens to you and you die young. It's all, you know, written out there for your beneficiaries. Are your beneficiaries properly titled? And we want to make sure that if you do pass, that they're all updated, because oftentimes we've seen that cause a lot of problems in families. We had a situation not long ago where we had a husband and wife, and they were married, and she had 3 children before from a previous husband. They were his stepchildren, but he never adopted them. She was listed as the primary beneficiary, and then she passed away. Then her husband never changed the beneficiaries and never added contingents. So the money didn't go on to the stepchildren, it went on to his siblings because it was never changed. But he intended to have the money go to those kids. He raised them as his own. And so those are some situations that we look at where we say, you know, it's really, really important that you get that looked at and updated as often as you possibly can.
Yeah.
So the next piece
makes a lot of sense. Actually, Janie, I think these are some things that a lot of people just don't really think about. I mean, I hate to say this, but it's like you get older and you get older, and there's always that sense of, oh, we'll take care of everything. We'll take care of everything. And then before you know it, something bad happens and it didn't get taken care of. So it sounds like an important part of this is don't wait until you're 80 and you got to figure everything out. Okay, do it now. You're in your 50s. Now's the chance to do it.
Good point. And you know, people don't think they're going to die, you know, and I think we're optimistic beings. That's just how we are. And that I think has a lot to do with it. So try to urge people to get that done for sure.
Right, absolutely.
But so really just putting these plans together, a big part of this is Social Security, and that's why I want to talk about Social Security next. And really what we found as planners is time and time again, we've been putting plans together, and we do this, hundreds of times throughout the years. And we would see that people would have gone to a Social Security, maybe they've gone to the office or they've gotten a software from somewhere, and they already knew about this is what I'm going to take it, and they would give us that information. But as we would be putting the plan together, we'd find that just was not, the best information. That wasn't the right time for them to take the Social Security benefit. And so, they were getting good advice, right? They were going to Social Security experts, and they were getting, Social Security software. And so you think, how could that be? How could that advice not be correct? But the problem with it was that really the disconnect is you could, give someone a Social Security advice, but if you don't know, how long they're going to work for, what's their savings like or not? Do they have a pension? What's their tax situation? All of these pieces can cause a really great Social Security strategy to be, a good or a bad decision, because really you need to have it all wrapped into the financial plan. And that is where all of this planning comes in. But I'm going to jump into Social Security right here. And the basic premise, with Social Security is that you have to work, you've got to get 40 quarter hours, which essentially is working 10 years full-time, and you have 40 quarter hours measured by the Social Security Administration. That means you're in the system and you have a Social Security retirement benefit. Okay, but then how do they calculate how much you actually get versus what somebody else would receive, right? And so what they're going to do is look at your top 35 years of wages, because somebody might get $2,000 a month, somebody else might get $1,500. And so they're taking those top 35 years, not the last 35 years, but the top years of your wages. Okay, and just simply, if you only worked 30 years, then they're just gonna go ahead and take those 30 years to arrive at what your actual benefit would be. And so here's really the chart on when you can take Social Security. Bob, when do you think it is that most people take Social Security? Which age would you guess that is the most common?
If I had to guess, and I could be way wrong, I'm going to guess a lot of people start taking it at 62, which to me, it doesn't make sense, because they feel like, oh, it's money I can start getting right now. But wait a minute, if you're still working, then you're not able to collect all of that anyway. And the number two, you're locked into that lower amount, 75% for the rest of your life. So
that's right.
To me, and you're the expert, not me, but to me, it just seems to make more sense to do it when it's at 100%. And I know some people might say, well, wait till 70. But then I also have to think to myself, okay, well, how much money could I have received for those 4 years between 66 and 70? Take that dollar amount. You didn't collect that dollar amount for the last 4 years. So now you have to ask yourself, how long is it going to take to make the difference at 132%? How
Right.
long? Last 4 years. So
Really good point.
You got to weigh out.
That's a good point, and you're right. At 62 is the most common time people take it, at age 62. The benefit of waiting, of course, is that it grows a little bit more, and you get 100% at your full retirement age. And I'm going to when I say age 66, let's just use that as that's the full retirement age, because it's different for every person depending on their birth age.
67. What's all that about?
Pardon me?
For me, it's 67. What's all that about?
Because you were born, you're so young, Bob. You were born in 1960.
Yeah, we're the same age. Don't talk trash to me, Janie.
Yeah, I know. So anyway, yeah, but this is a big, another factor people get wrong. And oftentimes they think, okay, every year I wait, I get 8%. But that is not true until your full retirement age up to 70. So right. For you and I, Bob, 67, every single year, 68, 69, we get 8% additional credits all the way to 70. And it doesn't grow anymore at 70. At 70 right there, you need to take it. Okay, I've had a couple of clients that, they're working in their 70s, 73, and they didn't take it because they didn't realize that it had stopped growing. Right. So if you know anybody, make sure you let them know about that for sure. But you're right. What is the break-even point? And really, Social Security has this formula. It's called AIME. Don't need to write it down. Don't need to memorize it. But basically what it says is that if you wait to take your Social Security at age 70, all right, and you live to age 80, and every single year you live past age 80, then you've made more Social Security dollars. You've earned more Social Security dollars over your lifetime because you waited to take it at age 70. And that just, you know, once again, that just depends, you know, I mean, that depends on how long are we going to live? Another question we just don't have the answer to. And so a lot of this planning, you're planning for the unknown, which makes it a little bit difficult for sure. But I always like to talk about legacy planning also. And if you are retiring at 62 or 63, I have clients out there that are doing that. And they're not taking Social Security because they really want to wait until they get their 100%. So what are they doing? Because they stopped working and they don't have wages coming out and coming to them anymore. Where are they getting the money to live, right? They're pulling it off their own money. So in this instance, I would say it probably makes sense to take Social Security, because if you have any type of a legacy goal at all, and I mean, you know, if you have anybody that you want to leave money to at some point in time, and I don't mean like a specific amount, for most people it's, okay, this money's for me and my spouse and whatever remaining will go on. But Social Security, that amount doesn't go on to anyone. And we don't know how long we're going to live, but your own money goes on and it can grow and compound. In that instance, if you now I'm going to jump into this eye chart here. I swear it's not an eye chart, actually. It's not a test. It is our Social Security. It's our full retirement age. And I just want to focus on this chart one quick second here in the red part there. That's just showing, okay, what your full retirement age is. And the reason I point on this is because Social Security, they really only feel that we have one Social Security amount, and that is our amount at our full retirement age, and everything is calculated off of that amount. Okay, so it's just, if you take it early, they're going to penalize you for taking it early, or if you take it later, then they're going to extend it up if you're waiting till 70 or beyond your full retirement age. So everything is really predicated off of this amount here. Okay, I just want to show that. And that also makes a little bit more sense when I start to talk about the spousal benefit here in a minute. So largest group there, 1943 to 1954. That's the right there, the prime, I think, of the baby boomers. That's the largest group there. All right, so jumping into spousal benefits here, the basic premise of how spousal benefits work is that you're eligible for up to half of your spouse's Social Security as long as it's greater than your own. Okay, so basically, as long as it's greater than your own, and some people, if you have both two income earners that were making the same amount, they don't often have that spousal ability because it doesn't make sense. They wouldn't be able to take it. Okay, but here, let's talk about John and Judy. And they are both age 66. They're married, of course, and their full retirement amount is $2,000 a month for John and $800 a month for Judy. Now, Judy has.
Can I ask you real quick? Why would Judy be 800 instead of 1,000? You said up to 50%. What
Right.
would cause this to be less than 50% as it is here?
Because this is her, yeah, that's a good question. This is her own actual benefit. So this is her, she's worked, and this is her retirement benefit. She has the spousal right of up to 1,000 though, okay? So she can get the larger number if she takes the spousal benefit. She doesn't get both though. She doesn't get 800 and 1,000. But in this case, you're right, Bob, she would take the $1,000 because she's weighted and she gets half, okay?
Okay.
Yep. But the spouse doesn't need to have 40 quarter hours to qualify. They never ever have to have worked a day in their life to get the spousal benefit. And, you know, people think, you know, how could that be? But when you think about it, this was established, Social Security came about in 1935, very, very common generationally for one person to stay home, take care of the house, raise the kids, and the other to go to work. So that's really a traditional rule there. They haven't changed that at all. So the only has to have filed in order for Judy to have the spousal right, in order for her to be able to take that spousal right. But another thing I want to talk about too is if you're divorced, but you were married for 10 years, you have all those spousal rights as someone that is actually married. Okay, so divorced but married for 10 years. I have a client. She was married for 9 years and 10 months, and she says to me every time I have to mention this because she said that just tell them to stall it. If you know anybody that's, in that process, tell them to wait a couple months, get them to stall in that divorce proceeding, because it's really thousands of dollars over your lifetime if you are eligible for the spousal benefit. So if you know anybody, that's a good tip there. All right, so let's flash back and let's talk about a different scenario with John and Judy. Okay, so let's say they're 62 now. So John's benefit at 62, it's less, right? It's not gonna be 2,000 anymore because he's taken it early. So his benefit is 1,500. So Judy, though, her spousal benefit at age 62 is $720 a month. Okay, that's her spousal benefit because she gets penalized for taking it early. She's only gonna get 36% of John's full retirement amount. Okay, she gets 36% of 2,000. So that's one of the, really the rules there that they hit you with. You're never gonna get more than 50%. If Judy waits, she would get 50% if she took it at 66, because she's taking it early, she's getting penalized. And it doesn't matter when John takes his benefit. He can take his at 62, 64. That has no effect on Judy's amount. It depends on when Judy's taking it, what age she takes it at. And I think that's a confusing part of all of this for people. So I'm going to show you just another scenario here. So like at age 62, let's say John doesn't want to file. He's still working, he likes his job. And Judy's like, I've had it. I want to get out of the workforce here. I want to retire, but she's not having wages coming in anymore, so she wants to take something. She's got to go to the mall. She's not going to sit home all day. She's got to spend money, right? So she wants to take her own benefit. So let's say she does that. Let's say Judy takes her own benefit at 62 and it's $600 a month. And then 4 years go by. Now John's 66 and he said, okay, I'm going to retire now. I'm going to take my benefit and it's 2,000. But now Judy has the spousal right because John has opened up his benefit. So now she can take that spousal benefit, but is she going to get 50% of it? She's not. She's not going to get 50% of John's at this point because they have a deeming law which says that whatever benefit you're for all of the benefits as well, that you filed for that other benefit. So she's locked into the 36%. Okay, so now she has a decision to make, right? I mean, she can take that 600 at age 62, and that's 600 a month for 4 years. And then when she is able to get the spousal benefit at 720 a month, she would get that forever, okay? Or she can do nothing for 4 years and get the 1,000 forever at age 66. So she's got a little bit of a decision to make there. It just depends on so many different factors, like I mentioned. Okay. So the spousal benefit, it's never going to get higher than 50%. Okay, right there you want to, it maxes out, so you want to take it right there. At your full retirement age is 50%. So, like our own benefit can grow to 70, not the spousal. It maxes out right there at your full retirement age. And the spouse can remarry and still get that spousal benefit. So John could have been married to Judy, Sally, and Wendy, these 3 women. If he was married to all 3 of them for 10 years, okay, and divorced, each one of those women could still get the spousal benefit off of John's record, off of John's Social Security benefit. But he doesn't even know that it's happened. It has no impact on John whatsoever. He could even be married to someone else, and she could get the benefit. As long as they were married for more than 2 years, she'd be able to get that benefit off of John. Okay, so it has no impact. And I think that's a rule that is not real clear to people. But the other thing they don't make you do is you don't have to your ex-spouse does not have to have filed. It's all that has to happen in order for you to get the spousal benefit off your ex-spouse is they have to turn age 62. All right, so once that ex-spouse is 62, you could then go in and get the benefit. But, for whatever reason, Social Security doesn't make you, call up your ex-spouse and say, hey, you filed for your Social Security benefit yet? No, they don't do that. It's probably a really good idea. I'm sure it saves a lot of fighting. So they just say, okay, at age 62, that's when you take it. That's when you're eligible, as soon as your spouse hits 62.
Got it.
All right, so we're going to jump into survivor rights here, survivor benefits. And this is obviously what happens when one spouse predeceases the other. And we're going to talk about John and Judy. Let's say back here, they're 66 again. Let's say John files for his benefit right then, and then he passes away. So his benefit is $2,000. Okay, Judy's going to step up and get the larger of the two. She is going to get the $2,000, but the $1,000 goes away. Okay, and that's $1,000 a month that she's going to be without. And this is just an area of planning where you want to make sure that, you know, you think about this. What's going to happen to that spousal benefit? And will that spouse have enough money in retirement to live on their own at that point in time? And that's part of where all this planning comes in. I had an interesting story about a client that we were working with, and they were husband and wife, their second marriage. Both of their spouses had passed away, previous spouses, and the husband was sure that his current wife was going to get 100% of his pension when he passed. So they were really spending down her assets, knowing that she'd be taken care of if he predeceased her, and he was a bit older than her. Well, I knew that he had retired young, and so I said, I want to see, you know, what that pension benefit, the paperwork information is there. Who did you list as your beneficiary there? And sure enough, it was his first wife who had been deceased. So there's no longer eligibility at that point. It does not pass on to the current spouse because you have a marriage certificate. It does not work that way. And so she was not going to receive any of his pension whatsoever. And so good that she didn't find out about that when he passed away, right? Because we were able to plan for that and make sure that they stopped spending her money so she would be taken care of later on. But little things like that are so important to stay on top of. And I feel like, you know, years and years pass and people just don't look back at that information. Really important though to do that. So we know here that Judy would get $2,000. She gets John's, the larger of the two. Because John waited to take it at 62, he filed at 66. He waited his full retirement age where he got 100%. So he filed there, and that's why she's eligible for 100% at her full retirement age. Now, rules are different if you take it early. They penalize you again. So age 60 is the earliest that you can take the survivor benefit. So if you are a widower or a widow, you can take it at 60, but once again, they're going to penalize you. You're only going to get 70.5% of the deceased benefit. And why is it 71.5? Well, I think they just like to take this really complicated subject matter and just make it all that much more complicated. 71.5%, anyway, of the deceased benefit. But let's just use an example here to show this. So Steve, let's say we're going to talk about Steve and Wendy here. Steve and Wendy are married. He is age 62. She's a little bit younger. She's 59. Let's say Steve's full retirement amount at age 66 is $2,500. And if Steve takes his benefit at age 62, what's going to happen? So he takes it early. Let's say he's going to take it at 62. His reduced benefit is $1,875 a month. Okay. And let's say he takes it at 62 and then passes away. Now, Wendy at 60, smaller amount because Steve took it early. Okay, so her benefit is only going to be $1,340. And you can really see how these rules work differently and how they penalize you every way along the way for taking it early versus if you wait, you just get, you know, that benefit of the growth there. So that can really have a detrimental effect here especially if you did not know that. But a point I want to make is if you never make it to your full retirement age or you never take your Social Security benefit, people, you know, pass away at 50, what then happens? Well, your spouse is eligible to receive 100% of your benefit as long as they wait until their full retirement age. So if Wendy waits till 66, she would get 100% of that age 62 benefit, which is $1,875. But if Steve had waited to take it at 66, or if he took it at 70 and it was larger, it depends on when she takes it as to whether or not she gets 100% of the benefit. So it's 71.5 at age 60. It increases a little bit more each year, like Everything deals with Social Security and until she gets to 100% of the deceased benefit at her full retirement age. That one's a little complicated. So we might have some questions on that, and I get that, and I'll be happy to answer any questions, Bob. Like I get these all the time when I'm speaking. You want to make sure that everybody is understanding that.
Actually, there is one question I wanted to ask you. It goes back to something a little bit before, but I know if somebody takes Social Security before full retirement age, then any income that they happen to be making on the side is going to reduce the amount that they're able to collect. However, if they wait until they're at 100% retirement age, 66 or 67, then they still get that 100% no matter how much extra money they make on the side, correct?
Yeah, that's really interesting. And yep, you were on my next topic that I was going to just jump on here, which is earnings test. And that's called the earnings test. You're right. So yeah, I mean, at age 62, can you take Social Security at the same time when you're working? Yes, you can, but they're going to penalize you if you make over $18,240 a year. For every $2 you earn over that amount, they're going to reduce your benefit $1. Okay, but the year you actually reach your calendar year of your full retirement age, you can make $45,360. For every $3 you make over that, they reduce your benefit by $1. But you're right, Bob, when you hit your full retirement age, they don't care. They don't care how much you make, they don't penalize you at all. And a lot of people think, you know, okay, well, the year that, let's say I retire in June and I've already made more than $18,000 a year, of course, but they're not looking at it for the year. They're saying at the same time, are you taking a Social Security check at the same time you're getting wages? So what is that? That would be like if you are a contractor and you work for yourself, okay, or any kind of wages that you receive. I'm not talking about pension income, right? It doesn't count for monies you're pulling out of your IRA. If you own rental income, that does not count either, okay? So we're really talking about earned income, and there's a different definition there. So just want to talk about that. Now here's all of our favorite topic, taxes. And I have to say, the good thing here is I can't see people if they're sleeping during this tax part of it, because there's something about even just the word taxes, I'm not sure, people just kind of glaze over when I start talking about taxes, Bob. Do you know why? I don't get it.
I don't know. I'm staying awake.
Yeah, I know you are. Well, so this is going to be really exciting, and this is going to be great information for people to hear about. So I'm going to try to keep it very, very high level. All right, so basically what Social Security does is, yes, they tax you on your benefit potentially. So they calculate something called the provisional income, which is where they take half of your Social Security benefit along with everything else that you're pulling out. And things are taxed differently, right? So if you pull money out of your IRA, that's taxed dollar for dollar. You pull money out of a Roth IRA, that's not taxed at all, right? So my next chart here is going to show us the taxation on the Social Security benefit. So if your provisional income, which is everything I just mentioned, half your Social Security plus what you're pulling out, okay, if that is below $25,000 and you are a single filer, then none of your Social Security benefits going to show up at all on your tax return, zero. But if you're married filing jointly and you're above $44,000 for that provisional income, 85% of your Social Security is going to show up on your tax return. That is the max. Okay, they're never ever going to tax at all. Even you could be Warren Buffett. I don't know if he takes Social Security, but only up to 85% is going to show up on his tax returns too. So that's a rule that they have not changed either here. But just to keep this chart in mind for my next example here. So let's say a couple has a goal, an income goal of $50,000 a year total. That's what they need, right? Their Social Security income is $30,000, but half of that is 15. Okay, so they're gonna take 15,000 and then they pull 20,000 out of their IRA. So that IRA all shows up there so that your provisional income would be 35,000, which means half of your Social Security benefit is gonna show up if you're married filing jointly, see, because they are right there at 32,000 to 44, then 50% shows up on their tax return. But we like an alternate plan here, and this is what we want to look at. So what if you just take whole 20,000, and then you take the final 3,100 from your savings, your provisional income is still 15,000, that puts you at 31,900, so none of your Social Security would be showing up at that point in time on your tax return. And tax planning, you know, in retirement, it's just so important to talk about it, because this is really the one time where we get to choose, you know, where we pull our money from. Because when you're working, you really don't have the choice. You really, every dollar of wages you're earning is being taxed unless you're deferring it, you know, into an IRA or 401k. But basically, you don't have a lot of options. But in retirement, every dollar you pull out is taxed differently. We know that IRAs are taxed dollar for dollar. Roth IRAs, if you set them up properly, not at all. We've got cash value and life insurance, not taxed at all. The capital gains, short-term and long-term, are taxed one way, dividend income another. And that's really where tax planning and retirement is so important, because if you accidentally pull money from one place, it could cause Social Security to be taxed, which could maybe push you into a higher income tax bracket, causing dividends and capital gains to be taxed, et cetera. It's really this domino effect that we want to try to prevent in retirement. And the best, really a great source today is Roth assets and Roth conversions. With Roth conversions or Roth contributions, if you can contribute, you're never ever going to take RMDs on that money. So what are RMDs? RMDs are required minimum distributions, where qualified money, which, you know, people have been putting money into these plans their whole life, their 401ks, that's usually the majority of your assets when you retire. But you're going to be taxed on that whole thing. And then at 72 now, they just moved it up to age 72. The IRS is saying, hey, we want to tax that money. So you are forced to withdraw it out. You have to take it out. And you might not even want to spend it all. You might want to spend some of it, but probably not all of it necessarily. But you're still going to get taxed on it. And then what's that going to do to your tax bracket? That could push you up into a higher bracket. And we really know one of the solutions today is that we are in a very low tax environment. The tax tables, that tax law that was passed by Donald Trump there in 2017, essentially, basically that has put us at new lows. And so it makes sense for a lot of people today to look at converting. What I mean by conversion is you can take your IRA money, or you can convert your, let's say you have a 401k, convert that to an IRA. You're going to take that and pay some of the tax on that slowly, gradually over time into a Roth IRA. If you have a Roth IRA over 5 years, you're not going to have any taxes on the gain and any tax on the principal of that money, as long as you've had it there for 5 years and you're over 59 and a half. So that's a great asset. And it just grows and multiplies there with no tax. And what a great thing to have. We feel, you know, if you're going to be 72 in 10 years, and even when you are in your 70s and you're taking those RMDs every year, you know, really we know taxes are going up, especially with the stimulus programs here. We've had to take more money. We've had to increase our deficit here really twofold. So we know taxes are definitely going up in retirement. So this is an area that we really want people to focus on, and we'd be happy to walk people through that. But really, the other thing I want to talk about is contributions. So there's two things you can do potentially. Anyone can convert. There is no rules about how and when do I convert my money. It doesn't matter how old you are, and it does not matter, you know, what your income level is. It just depends on how much tax you're going to pay that year, and that's something that you want to talk to your CPA about, and we have CPAs we can help you with also. But then the contribution is something that if you're married filing jointly and you make under $206,000 a year, you and your spouse both can open up a Roth IRA and put in $7,000 a year. After age 50, it's $7,000. That's the catch-up provision. Before that, it's $6,000. But you can put that money in every single year and get that Roth growing. And so you're not having to convert necessarily because you're contributing. And that's just a great plan for people that can go ahead and do that. And even if only one spouse is working, you can still open it up in the non-working spouse's name, as long as somebody has income coming in, as long as someone has wages that they're receiving, you know, for that year. So it would count that way. So also, this tax tables are going to sunset in 2025, which is why we feel that we've got a short window of time here. And then depending on what happens with this election, you know, we know that taxes are going to be going up. So we might have a couple of years here because you want to do it gradually. You don't want to take it all and do it at once because that could be terrible for your taxes, right? So slowly, gradually, we know we have a couple of years here before the taxes are going to be going up. And so that's why we want to visit it today. But we would really be, you know, happy to sit down with anyone. We are fiduciaries at Kelly Capital Partners, meaning what it is it's incumbent upon us to put our client's best interest first. Seems weird to have to say that. Not our best interest, but their best interest. That's really important in retirement. And this is just showing you a little bit of what our actual roadmap looks like, our Kelly Capital Partners roadmap. We'd be happy to go into detail for people and go ahead and customize it to their specific situation because it's so important. We take all of these elements into consideration because no two people's lives are the same. No two people's, you know, situations are ever the same. Their money's not the same. So we would like to go ahead and schedule an appointment with one of our advisors here at Kelly Capital Partners. You can go to wmuz.com/Kelly Capital, or you can give us a call at 248-262-7217.
Sounds
And
great.
that's it for now, Bob. I would love to, if anyone has a question, they can go ahead and send them in. I know on your end, and we'd be happy to, or they can email us at info@kellycapitalpartners.com.
Yeah, that'd probably be the best thing for them to do. Just email you any questions, info@kellycapitalpartners.com. But, you know, and I don't mind telling everybody in the audience, really, go ahead, go to the website, wmuz.com/Kelly Capital. And Janie, you're willing to meet with my listeners and talk with them free of charge, basically, and go over some plans and some ideas for them initially in a meeting for free.
Absolutely, yeah, we're happy to handle the consulting there for sure, and there's no charge for us to sit down and consult with
Right.
people. We're happy to do that, absolutely.
Absolutely. Well, folks, I would encourage you to do that, okay? It just makes sense. You've got nothing to lose. Why not find out what they can potentially do for you at Kelly Capital Partners? And so,
Absolutely.
Janie, this has been a great webinar. I mean, it's a lot of information here. And it occurs to me that a lot of people aren't going to necessarily remember everything that you said, which is all the more reason.
Really?
We'll figure.
You don't think I memorized that?
So, which is all the more reason why they need to call you and say, hey, you know what, can I set up a time to kind of meet with you and go over some of this stuff? And I know you're happy to do that with my listeners, and it's great.
Oh, absolutely. Absolutely. Thanks so much, Bob. Really appreciate the opportunity.
Thank you. And everybody joining us, we appreciate you being with us today. Again, go to wmuz.com/Kelly Capital or give them a call. And Janie Kelly, thank you so much, Janie.
Thanks, Bob. You take care.
Hey, you too. We'll see you. Bye-bye.